I want to bring on today's guest, Mish Schneider. Mish is the chief strategist at MarketGauge.com, coming to us from Santa Fe, New Mexico. Mish, great to see you. Welcome back to the show.
Thank you so much, Dave. It's great to see you as well. And I want to start by saying you hit the nail on the head when you said at the top of the show that all of the talk about what the market is going to do and what it should do and all the numbers and the CPI and the PPI and the FOMC and on and on and on really has proven to be meaningless, as you said, because the market doesn't care about these typical relationships. So I just thought I loved hearing you say that because that's really what it's all about right now.
I love that. Thanks for saying that, Mish. A former therapist used to call that shoulding all over yourself. If you keep saying should do this, should do that. And I find that with investing as well, right? I don't worry about what should happen. Focus on what is happening. Let's get to your charts that really tell, I think, a really compelling story about what is happening. We're starting with regional banks. Certainly important this week because we have earnings starting next week. A couple regional banks represented. What is the chart of the KRE telling you here?
Well, what's so interesting about this chart is that it's almost become somewhat about a month ago or so in the beginning of March when it started to break down, actually even before that, under the 50-week moving average, it almost became a lead indicator that something was rotten in Denmark, right? And so right after that, the stories broke about SVB and all the rest, and there you go. And so I wouldn't necessarily say it's the lead indicator right now, but it is still an important indicator. And this is a weekly chart because you can see that so far, we really haven't done very much while NASDAQ and the diamonds are starting to rally here and some of the other sectors are picking up. And so that tells you two things. Number one is that cycle has seen its day. And in terms of banks, that's not where you're going to go to make any money. And it might even turn out to be a good hedge if you want to be in a hedge for the short side. Or it just could be that the earnings will come out as a surprise and we'll see some serious catch up here. Regardless, if we break down under those three lows that we had there, which all are around 41.50, I would take that more as a cautionary tale than anything else. And if we can get through 44, particularly after the action we've seen today, then I would say maybe not the place to go unless you really like bottom picking, but at least a worry you don't have to worry about in terms of what you're hearing from people like Jamie Dimon, that the bank crisis is not over yet.
Yeah, there's still some. I wonder how many question marks we'll be able to, I guess, erase after this this coming week. But I feel like there's still it's still an open question in a lot of ways. And thanks for highlighting that continued downtrend. Compare that now to the second chart, the high yield ETF, HYG. What is this telling you?
Well, this is exactly the opposite. So, right, junk bonds are a place that bond traders go where they want to collect a high yield on high debt companies, which are companies that don't do well and don't have good balance sheets, but pay a much higher yield as a result. That is the ultimate risk on situation, right? And so I've been watching this in the last couple of days when people were starting to say we are going into deep recession and we're going into disinflation and the world's coming to an end. And I'm looking at this chart going, well, bond traders don't seem to think so, because why would they be right into earnings season buying these companies? So you can see that there was kind of a bull pennant there that was forming. This is another weekly chart. And we kind of broke out of the pennant over the 50-week moving average today. Now, we're not at the high that we were a couple of weeks ago, and we still have one day left. But I would say that given what we just talked about on the negative side with the potential of the regional banks, if you want to have more confidence and be a buyer of the market overall, if this closes not only over the 50-week tomorrow after the earnings, but also over the high of 2 weeks ago, I would take that as a pretty confident sign that this rally isn't over. And the second part of that that's really interesting to me is if you wanted to have some kind of target, I would say this could rally up to around 78, which would give you an opportunity to say maybe at that point the SPYs are trading at 440, which means it would get through the 420 and go further, maybe even get everybody in. And then, of course, we know any catalyst could happen that would turn that around. But at this point, this is giving me more confidence than anything else.
And it's amazing. I mean, while it's I guess, arguable as to how constructive it looks, right? Because it hasn't quite broken above resistance from January, but it's certainly not looking negative, right? So it's hard to be super, like how, I always think of it this way, how negative do you want to be when the HYG looks like this, right?
Exactly. And it also is a lesson in
Hmm.
trade right now, what has the momentum,
Hmm.
and really don't necessarily even look at some of the other places. I mean, it'll give you a better focus, number one,
Yeah.
give you much more profits, number two, and it'll also erase a lot of that noise that are constantly being bombarded with right now.
Your next chart, Mish, is semiconductor, certainly a group that has been, I mean, on a relative basis, one of the better places to be year to date. What do you see in the SMH now? What does it tell you about the conditions here?
Well, this is a daily chart just to
Yep.
confirm time frame. So I think the last time we were together, Dave, we talked about the 23-month moving average and
Hmm.
why all of a sudden this year, it's a moving average I've had on my charts forever, but this year it became really important, especially after we had the great rally in 2021 and then the great decline in 2022. And this year has been sort of the WTF year, like, and that's exactly what we're talking about, right? But meanwhile, the semiconductor chart has actually been the only one until today, the diamonds took it out, that took out the 23-month moving average.
Hmm.
So I decided let's take a look at the daily chart because this is going to be also super important. As you mentioned, growth overtook value today. And this is where NVIDIA lives and a bunch of other companies that are going to be reporting as we get into earnings season. And yet it's bouncing off the 50-day moving average. And the key area really to look at right now is around this 246, 247 level, because not only is it the 50-day moving average, but it's also the 23-month moving average. So
Oh.
we can see fake outs of something going over a 23-month and then failing it. So regardless of what's going on, given the other two scenarios I just talked about, junk bonds into resistance, KRE and regional banks not looking great yet, this as one of the leaders really needs to stay in the game. And this chart tells the story.
At the bottom, these are your charts that we're sharing, Mish, and thanks again for sending these. At the bottom, we have your real motion indicator. It's part of your ACP plugin on stock charts. For those that aren't familiar, I think of it as just a measure of, I guess, a measure of momentum. But how would you describe what the real motion is telling you here on the SMH?
Well, I'm really glad you pointed that out because this can be either a lagging indicator or a leading indicator in terms of momentum. And very often when we see a divergence, that's when we're interested. So we look for a couple of things. Number one is we look for a mean reversion, which we had just a little bit ago when we were making the highs in semiconductors. It went through the Bollinger Band and broke back below it. And I know you have quite a number of people who are mean reversion watchers. And that's one indication. But look where it's at right now. It's sitting on the 50-day moving average, just like the prices, which means the momentum and also the price are flattening into support, which could be noteworthy. We can't say that just yet. But it also could just be that the market is taking a pause here until we see this next round of economic data coming out. Of course, earnings being probably the number one situation that everybody's looking at right now.
Absolutely. I'd love to talk about a couple other charts if we could with the time we have left, Mish. I want to talk about gold and full credit where it's due. You were part of our Charting Forward Market Outlook special back in January. You mentioned gold as a really good place to be. Well done on that because it's obviously been one of the few places in the market that have just been truly resilient kind of working. I have the GLD that I'll bring up here to take a look at, but I'd love to for you to just talk about what you see in the gold space right now. Is it too far, too fast? Is it overextended or something that you would still think about following here? What's your take on gold?
Well, I don't think it's too far, too fast. If anything, I thought it was so undervalued that it's finally starting to look more in line with what our inflation numbers, whether people think that we're in deflation or not, it doesn't matter. To me, just looking at this chart, of course, it's also been the flight to safety, but today where we had more risk on, it still went up. So gold has been in demand from a physical standpoint. There have been countries buying large bundles of gold, number one. But number two, what it's really telling me is that there's a little bit of fear still in the market. There's still a bunch of raw materials that are under siege. Like, for example, if you're looking at the softs like sugar and coffee, if you're looking at copper, even if you're looking at steel, they haven't gotten going yet, but they can. Oil is consolidating, but at a higher level than it was a couple of weeks ago. You know, we're right at around $80 to $82 a barrel. So I think gold is projecting that we're not out of the woods by any means. We have geopolitical situations that are certainly fearful. They may or may not play out, like with China, Taiwan, or what continues to go on with Russia. Also, we have the dollar, which has been declining. The question of what happens to the currency as a world reserve. All of this is right here. So I actually think that as long as we hold this 2,000 level, doesn't mean we can't see corrections. But my prediction has been a move up to 2,400 to 2,600. And now you can see it's peaked out of this Bollinger Band here, which generally means if it stays there, that could be almost like a fat tail trade. I could just be getting going.
It's amazing how gold, I feel like we talked about gold so much last year and it struggled. And all of a sudden, it's so impressive how that market has changed. A great reminder to focus on the trends and focus on what the charts are telling us. Mish, it is so good to see you. Thanks for sharing some charts and some ideas with us. Best to Keith and Jeff and the Market Gauge team. We'll talk to you again soon, all right?
Thank you so much.
That's Mish Schneider. Mish is the chief strategist at MarketGauge.com, coming to us from Santa Fe, New Mexico. I love her discussion. Just think about some of these different areas, particularly high yield. When I talk with Mish, we often end up at high yield debt and looking at the HYG. And what I have found certainly is individual investors a lot of times are sort of under-aware, if that's a word, of what's happening in the fixed income markets. And on the institutional side, I was always taught, particularly in periods of market uncertainty and certainly in bear market phases, the best thing to do is call the people in the fixed income team and see what they're thinking about. Because bond investors tend to be way more focused on risk, potential risk than potential reward. And as a result, they usually have a really keen eye for recognizing weakness and potential weakness and risk factors. So when things like high yield debt are doing well, that tells you bond investors are getting a little optimistic. It might be an important chart to watch. A great take, as always, by Mish Schneider at Market Gauge.